Hello and welcome back to the Issue at Hand Market Brief. I'm Chris Aleman, and I'm joined by Mike Sanders. How you doing, Mike?
Doing good.
So before we dig into exactly what came out of the meeting, I wanted to recap a couple of things that we kind of expected going into this meeting. One of the questions that we had was, is the Fed going to stick to its mandate, its dual mandate of stable prices, maximum employment? 2, what was the Fed's outlook going to look like under the new Fed chair? Was it going to be more dovish? Was it going to be more hawkish? And then I think lastly, we just wanted to make sure that the Fed's credibility kind of stayed intact with this. So I guess with all that as the backdrop, Mike, what did we hear yesterday?
Yeah, so we heard a lot. From a dual mandate perspective, not a lot discussed in terms of the labor side. It was much more about the price stability side, getting inflation back down to 2% explicitly in the statement. And so that definitely kind of led to a more hawkish overall tone. I think when we chatted prior to the meeting, it was, well, they can't be dovish. It's a credibility issue. Maybe neutral to hawkish is where they'll go. And the statement and how he discussed their discussion behind closed doors was definitely in the hawkish end of the expectations. And, you saw that kind of in market reaction with, front end interest rates increasing quite significantly, 2-year moving higher. And then the back end, 10s and 30s. 10s moved a little bit higher, but 30s
Not much, yeah.
Slightly down. So,
Yep.
For long-term bond investors, you want a Fed that wants inflation lower.
Yep.
So.
Well, I think one of the things that, we went into going this too was there anything that sounded materially different from the last era, I guess, with Powell? Like, was there anything that you got out of this that you see like, hey, this is going to be different?
Well, I think the one thing that's different is Warsh didn't provide any dots. He didn't provide any guidance of what his thinking was.
He didn't provide his own dots.
His own dots, yeah. And so there were dots by the other members, and pricing from a dots perspective in terms of, Fed funds rate, half of them, indicated a hike by the end of the year. Warsh definitely wants to provide less guidance and wants the market to react to incoming data, and then the Fed can react how they want to react. But it's definitely a different perspective than what the recent few Fed people wanted, and so it's probably closer to what Greenspan had way back.
Can we come back to that? One of the advisors asked me a question: is why is that important? Why wouldn't we want to hear the Fed basically laying out everything as often as possible?
I mean, Warsh was asked that specific question, and, his response, at least my interpretation of it, was that he would much rather have markets kind of provide the data, understand the data, and react to it than the Fed, because forecasts change, right? if you think about it, oil prices are falling. You have the deal signed or will be signed with Iran.
Not signed yet, yeah?
Yeah, so it's information changes very quickly. I think he just would much rather have the market react to it, and then the Fed can decide what they want to do. But he's a big believer in market pricing and market changing and incorporating information into what is priced in.
Yeah, I think that was important. I got that question. And one of the things I also liked was Warsh's comments before the meeting was basically like, I don't want any of the governors to kind of be hemmed in based on some of their earlier comments. I want them to have that flexibility. So I thought that was important. I think the other thing that I wanted to bring up was, you mentioned it earlier, was the dot plot. We didn't get it from the Fed chair, but we did get it from everybody else. So what did that tell you about the potential for hikes or even for pricing perspective? You touched on it a little bit, but can we get a little bit more into the details?
Yeah, 9 of the 18 dots were for a hike, 1 or more hikes. Some of them had 3 hikes. There was one that wanted a cut, and then another, their balance wanted no change through the end of the year.
Yeah.
Again, that could be old information based upon what we see in the energy markets going forward. But, the market had priced in a possibility of a hike in 27. That's been kind of pulled forward given the dots for whatever they're worth. And the dots are one thing, but even the tone and the hawkish commentary from Warsh kind of pulled forward the possibility of a hike through the end of the year, third quarter, fourth quarter type, the end of the third quarter into the fourth quarter type possibility. So the dots and the hawkish tone definitely hurt the short end of the curve, with rates going pretty high, I guess moving higher given expectations prior.
I think it sounds like your biggest takeaway was kind of from an expectations perspective, like short term, we're still ready to stay neutral, but I think longer term, maybe not even longer term, maybe Q3, Q4, as you just indicated, it'll have an impact on bond prices. So as a bond investor, how should we look about being positioned given the expectations for where we think rates are going to go?
I think a Fed that is very, very aware of and wants to get back to the 2% price level is going to keep longer term bond yields at levels today or possibly lower. I think that's the biggest takeaway.
Yeah.
Our feeling before was, the Fed would cut rates to help the labor market if the labor market will falter. The fact that the Fed didn't really even mention the labor market, now because the market's doing fine, right? The unemployment rate.
But I still think it was pretty telling. Yeah.
Yeah, but it definitely seems that, still obviously the dual mandate, there was no sunlight in there, if you will. There is a very, very strong focus on the inflation side. And, that's going to be good for long-term investors. Might be some pain on the front end at points in time, depending on how the data evolves. But from a bond investor perspective, it's a good thing. You want to keep inflation so your real returns are going to do better.
Yeah. Well, I think I guess to recap what we've been talking about is, did the Fed stick to its mandate? Yes, I think they are still focused on employment and inflation, as you mentioned. Did the Fed's comments for future expectations, what did we see from that? I think it was, I guess if I can sum up what you said, it was a little bit more hawkish than we kind of went in thinking. As you said, everything's kind of being pulled forward. But for right now, again, in the short term, nothing's changing. And then I think lastly, I think the credibility, I think to your point, when you're focused on the data and having the data dictate where you're going to go, I think it was good to hear the Fed, again, reinforce that and stick to it. So I guess that's my recap. Is there anything else that you heard that hasn't been mentioned that you think everybody wants to hear about?
Yeah, just two things I would add would be, one, that any thought that there be some political bias to Warsh is gone. He was unbelievably independent, I guess, given, prior statements.
Well, I feel like, I don't want to say unbelievable. I think he did what he was supposed to do.
Yeah, exactly. He was hawkish. The data says he should be hawkish, and he was hawkish, and he wasn't apologetic of being hawkish.
Exactly.
I think the other, interesting thing that we'll see how this evolves. I don't think it's an immediate movement in rates, but, down the road, there was these task forces that were brought up.
5 of them, in fact.
Yeah, five different task forces, and obviously different parts of the economy, how the Fed looks at productivity and jobs and how they communicate, and lots of different items to view. And again, nothing immediate, but that's going to change how the Fed looks at data, how the Fed communicates with the markets, and it'll be something that we'll be watching for down the road. Again, I don't think it's going to be the next Fed meeting we're going to start getting impacts from these committees, these task forces. But I do think that, down the road, it's definitely going to change how the Fed's going to interact with the market participants.
No, that's a great point. I think when I heard just the sheer number of task force, I thought it was interesting. But I think that's a good place to stop there. So what do you think?
Yeah, I think so.
All right. Well, thanks, Mike, again for sharing a lot of your insight on this. And thank you, everyone, for joining the Issue at Hand Market Brief.